Hello, my name is Alex Tapia. I'm the president and founder of Aviation Retirement Strategies. I'm here today at our corporate headquarters here in Houston, Texas at the George Bush Intercontinental Airport. And today I want to explain a little bit some of the things that you might have been hearing on the news that tends to confuse a lot of people. And I'm talking about rising yields and interest rates and all that stuff that's causing some volatility in markets. And if you haven't noticed, it's been kind of up and down every single day, especially on the tech side, on the tech sector. And it's been every time somebody says something about rising yields and interest rates and all those kinds of things. So I thought we could maybe explain that to you. What exactly does that mean? Because it tends to confuse a lot of people. So let's talk about the Fed. Let's talk about interest rates, but let's do it in layman's terms. So what is it that they're talking about? You've been hearing a lot of talk about yields rising lately because there's basically an optimism for an economic revival following the economic misery that COVID-19 brought onto us last year. So there is also an expectation that inflation will also come along with it. And that's basically the key, because those yields from the treasury, the 10-year treasury, they form the basic foundation that the financial world uses to try to figure out the value from anything from the stock of a company like Apple to a junk bond. Now, for years, yields have been ultra low for treasuries, meaning that investors earned very little in interest while owning them. That, in turn, made the stocks and other investments more attractive, which drives up their prices. But when the treasury yields go the other way and they rise, so does the downward pressure on the prices for other investments. So here's a look at why the recent moves in the market has been so volatile. Why are treasury yields rising? Well, part of it is an expectation for inflation, which is probably the worst enemy of a bond investor. Inflation means that future payments from bonds won't buy as much because the price of a banana or a bouquet of flowers will be higher than it is today. So when inflation expectations rise, bonds are less desirable, and then their prices fall, which pushes up their yield. Treasury yields also often track with the expectation for the economy's strength, which is on the rise. So when the economy is healthy, investors feel less of a need to own treasuries, considered to be the safest possible investments. Well, let's say that I bought a bond for $100 that pays 1% or $1 in interest. But I'm worried about rising inflation, and I don't want to be stuck with this bond because I know that the value of $1 will be worth less in the future. And so I'm going to turn around and I'm going to try to sell it to somebody else. And when I sell it to somebody else, let's sell it to them at $90 or $10 less than what I bought it for, that 1% is actually going to be a larger percentage, because that bond, no matter at which price I sell it for or buy it for, it is always going to pay the same amount in dollars in the interest that it pays. So that 1% return, so they're going to be getting more than that 1% return on their investments, because their regular payouts coming from the bonds will always be the same. So why are inflation and growth expectations rising? Well, the corona vaccines will hopefully get economies going this year as people feel more comfortable returning to shops and restaurants and businesses reopen, and workers also start getting their jobs back again. The International Monetary Fund expects the global economy this year to grow at about 5.5% this year, and that follows last year's plunge of about 3.5%. So a stronger economy often goes along with higher inflation, though it's been generally trending downwards for actually the last several decades. And Congress is also close to pumping in another $1.9 trillion into the U.S. economy, which also could further boost growth and inflation. Okay, so why do the Treasury yields and these rates, why do they affect stock prices? Well, when you try to figure out what a stock price should be, you usually look at two things: how much cash the company will make and how much to pay for each of $1 of that cash. Well, when interest rates are low and bonds are paying very little, investors are willing to pay more for that second part. They're not losing out on as much income if they had put that money in the treasury instead. So what happens now that interest rates are rising? Well, the recent rise in yields is basically forcing investors to pare back on how much they're willing to pay for each $1 of future company earnings. When they're getting good returns from guaranteed payments from safe investments like treasuries, when their yields rise, they are less willing to pay a premium for that $1 of future company earnings. Stocks with the highest prices relative to earnings are getting hit hard, as are stocks that have been bid up for their expected profit far into the future. Big tech stocks are in both of those categories, which is why you've seen so much volatility in that sector lately. Dividend-paying stocks also get hurt because investors are looking for income, can now turn instead to bonds, which are much safer investments. The ultimate worry is that inflation will take off at some point, sending rates much, much higher and increasing those safer yields. So some people ask, well, aren't interest rates still really, really low? Yeah, they are. Even at just north of 1.7%, the 10-year Treasury yield is still below the 2.6 level that it was at 2 years ago, or the 5% level as it was 2 decades ago. The concern isn't really that the 10-year Treasury is at 1.7%, is that it went from 1 to 1.7% in a very, very short amount of time. And what does that mean for the rest of 2021? Well, we think it could keep the rates could keep rising above 2% by maybe the end of the year. But we don't see it going back to the old normal of 4% or 5%, which could force an even bigger reassessment for the markets. Until that becomes more clear, though, we look for the stock market to stay pretty volatile. Well, so aren't stocks still really, really high? Yeah, despite the recent pullback in the markets, the major U.S. stock indexes all remain near an all-time high, set just within the last month. The S&P 500 is still within 4.2% or so of its record set back on February 12th. But hasn't the Fed said that it's going to keep interest rates really, really low? Yeah, pretty much. The Federal Reserve has direct control over the short-term interest rates, and Chair Jerome Powell has repeatedly said that it is in no hurry to raise them. It's not planning to trim its $120 billion in monthly bond purchases either, which is used to put downward pressure on the longer-term rates. Powell also said that the Fed won't raise its benchmark interest rate now that it is at a record low of 0 to 0.25% until inflation runs slightly above 2%, which is its target level. Powell also repeatedly said that while price increases might accelerate in the coming months, those increases are expected to be temporary and not a sign of a long-run inflation threat. So he echoed those statements also again on the last Thursday when he spoke, but analysts said longer-term yields rose on disappointment that Powell didn't offer something more forceful to tamp down those recent increases. Quote unquote, "We think our current policy stance is appropriate," unquote, Powell said. So is Wall Street still optimistic about the future? Yeah, much of Wall Street still expects stocks to keep rising. One reason is that many investors agree with Powell and expect inflation pressures to be only temporary. That should hopefully keep rates from spiking to dangerous levels. Also, after a dismal 2020 for most companies, investors are banking that growth in corporate profits will explode higher as more people get COVID-19 vaccines throughout the year and the economy gradually approaches something close to normal. If earnings rise enough, stocks can stay stable or maybe even go higher despite a rise in rates. Well, do some companies do well when interest rates are rising? Absolutely. Financial companies, particularly banks, have gained recently because rising rates can mean bigger profits made on a variety of consumer loans, including mortgages and other types of things. And if rates are rising on inflation worries, energy companies could benefit if prices are also rising for oil and other commodities. Overall, though, rising interest rates are a drag on companies because they make borrowing more expensive. This is especially painful for companies like real estate investment trusts or REITs, which require a lot of money and often debt to operate. People who rely heavily also on credit cards might also cut back on spending, which could have a ripple effect on all kinds of companies that rely on consumer spending. So these are some of the things that we're watching and we're trying to keep track of, and we're trying to adjust our portfolios to kind of adapt to a constantly changing environment. And as you will see in the near future, we're probably going to be making some changes to adapt to these changing times. But in the meantime, if you have any questions, if you have any concerns about your portfolios, if you want to talk something specifically about your situation, please give us a call. We're always available. But thanks for listening. We appreciate it. We look forward to hearing from you. Have a great rest of your day, and we'll talk to you soon.